In this video, we're going to discuss basic adjusting entries, why we record them, and go through some examples of how they would impact our financial statements. If we want to prepare financial statements at year end, say December 31st, 2020, we need to make sure that we record our revenues properly, as well as our expenses. Recall our matching principle. And we want to make sure also that our liabilities and assets are properly stated. So we want to make sure that revenues that we've earned in 2020 are recorded in 2020, as well as the related expenses. And of course, again, at December 31st, we want to make sure we've properly stated our assets, as well as our liabilities. So we're making adjusting entries to make sure we've properly stated revenues and expenses, as well as assets and liabilities. Adjusting journal entries will always change one balance sheet account as well as one income statement account. We're going to go through 4 broad types of adjusting entries. All businesses have the first 2, and some businesses have the second types of adjusting entries we talk about. The first type of adjusting entry we're going to talk about is the use of an asset, and it will involve the decrease in an asset and recording an expense on our income statement. So again, involves one balance sheet account and one income statement account. Most businesses make this type of adjusting entry. It records an expense for costs that were originally capitalized, and recall capitalized means recorded as an asset, but that have now been consumed or used up to generate revenues. Examples of assets that usually require adjusting entry would include equipment, prepaid, such as insurance or rent, and supplies. So we've brought that plant, property, and equipment. We originally capitalized it. We recorded it as an asset. We've used that asset to generate revenues. And recall, what do we do with those costs? The matching principle says we take cost used to generate revenues and we record it as an expense in the same period. So if we've used equipment this past period to generate revenues, we want to decrease the asset and record an expense. If we've paid rent in advance or paid insurance in advance and we've capitalized that cost, recorded as an asset, well, over the last year, over the last quarter, over the last month, that insurance has expired, that rent has expired. We want to record a decrease in an asset and we want to record rent expense or insurance expense. If we've purchased supplies and recorded them as an asset, as we use up those supplies, we want to decrease supplies and record an expense. So again, most all types of businesses make this type of adjusting entry, one that involves the decrease of an asset and recording an expense. The second broad type of adjustments that most all companies are going to have are what we call unrecorded liabilities or expenses. At year end, if we want to get that balance sheet right, we need to record an increase in liabilities, and we will record an associated expense. Again, notice one balance sheet account and one income statement account. Most businesses, again, make this type of adjusting entry. It records expenses that have been incurred, but we've not yet been billed for. Examples might include salaries. For instance, our employees work for us that last week of December. Are we going to pay them on December 31st at midnight, New Year's Eve? Not likely, but they've worked for us generating revenues, so we need to make sure that expense gets recorded in the current year, and we record that liability, the amount that we owe them on December 31st, if we were to pay them or if they were to leave. The other examples, utilities, interest expense, taxes. We've been using electricity this past month to generate revenues, so that means we need to record an expense and record an associated liability. So the electric company might not bill us until January 23rd for the electricity we used in December. Nonetheless, that was a December expense and a liability at December 31st. We owed the money even though we had not yet been billed. The same would be true for things like interest expense or taxes. If we've borrowed money during the year, we might not have to pay the interest until the following year, but we've made use of the bank's money. And what's the cost of using someone else's money? You have to pay interest. So we need to make sure we record interest expense in the current year and a related liability. And of course, the same thing would be true with taxes. If we owe income taxes for the year, we don't have to pay that until April, but it was an expense for the current year, so we want to record an expense and a related liability at year end. The last two types of adjusting entries we're going to take a look at are ones that not necessarily every company has. The first one would be what we call an unbilled or unrecorded revenue, which means if we've provided someone a service but haven't recorded it, we need to record both a revenue and an asset. Examples of companies that would record unbilled receivables at year end would basically be any type of company that provides a service over time and bills the customer on a periodic basis. Remember up here when we had to record a liability and an expense for electricity? Well, the person on the other side of that transaction is PP&L or our electricity provider. They provided revenues, a service in December, which was electricity. So they need to record a revenue. And even though they're not going to send the bill until January 23rd, they have an asset at year end, and they're going to record an increase in that asset, some sort of unbilled receivable. These types of adjusting entries are less common, but some companies perform these types of services, again, over time and billed on a periodic basis. At year end, they're going to need to make an adjusting entry. The last type of adjusting entry I want to take a look at is what we call recording unearned revenues. This is the situation where companies receive cash up front and record a liability, and over time they perform the service and they record a decrease in that liability. Some examples would be Millersville University, airlines, health clubs. For instance, Millersville University, when you paid your tuition, they're going to increase an asset, cash, and record unbilled or unearned revenue. That unearned revenue is a liability. They owe you a whole semester worth of educational services. Over time, as they provide those educational services, they would record a decrease in the liability and an increase in revenues. Of course, they don't record revenues every time we meet for class. So what they do is periodically, when they're ready to prepare financial statements, monthly, quarterly, at year end, they want to make sure that they've recorded all the revenues for services they've provided in the most recent period, and of course, decrease the related unearned liability. That airline, when you buy the ticket up front, they have an increase in an asset, cash, and they have a liability, unearned revenue. When you take a flight or fly in the plane, they've provided a service and will have a revenue and will decrease that liability. Of course, every time a passenger gets on a plane, they don't stop what they're doing and record revenues and decrease liabilities. They do this on a periodic basis. When they're ready to prepare financial statements, they'll step back and say, all right, out of all those liabilities on our books, how much of it have we earned? And to the extent that they've provided the service, they will record the revenue and decrease that liability. Let's go ahead and take a look at a few quick short examples. The first one we'll consider is the expiration of prepaid insurance. So again, we've paid our insurance up front. We had a decrease in cash and we recorded an asset, prepaid insurance. Over time, that insurance expires and we will have a decrease in assets and we'll need to record an adjustment for insurance expense. And of course, when expenses go up, our profit margin would decrease. How about the recording of depreciation expense? Again, depreciation expense is how we allocate or match the cost of plant, property, and equipment with revenues. So as we use our assets to generate revenues, we're going to want to record a decrease in our asset and, of course, an increase in our expenses. And this adjusting entry, again, would decrease our profit margin. Record, and by the way, these are examples of the first type of adjusting entry, the use of an asset, and most businesses make that type of adjusting entry, the decrease in an asset and recording an expense. The next one we're going to look at is the unbilled revenues. Unbilled revenues, again, that was a situation where we're providing service over time, phone company, utilities, and we've provided the service, but we have not yet invoiced or billed our customer. So at year end, we're going to want to record an increase in assets, which will be unbilled receivables. We don't want to actually increase accounts receivable until we send the invoice out. And we've provided the service, and so we have a revenue. Of course, when revenues go up, this would tend to increase our profit margin. Let's take a look at unearned revenues. This is an example of number 4, where the company collects cash ahead of time and then performs the services later. Our unearned revenue account, our liability, shows a $1,500 balance. Of this amount, only $500 remains unearned. So we, of course, have a decrease in our liabilities. We've provided $1,000 worth of service. And when we provide a service, we record a revenue, which would increase our profit margin. Salaries earned by employees have not yet been paid or recorded. This is an example of unrecorded liabilities or expenses. And examples were salaries, utilities, interest, taxes. So the salaries have been earned by our employees. That means we have what? A liability. We've increased our liability. We have to impact an income statement account. We've got salaries expense. And of course, expenses would decrease our profit margin.